Good morning, everyone. Good morning to you. Welcome to this Gravita webinar, Benefits in Kind and Update and Planning. I'm Tim Palmer. I lecture all over the UK. It's going to be a very practical session this morning. Away from my lecturing, I'm a tax consultant with Gravita, and which I thoroughly enjoy. And will you allow me just for a couple of minutes before I start the Benefits in Kind webinar to talk about Gravita generally, and specifically their tax department, which obviously I'm very heavily involved with. I've been working in tax since I was 18. And I would say that Gravita's tax department is the best tax department I've ever worked with. And I really sincerely mean that. I wouldn't say these things unless I meant it, and I do. I think Gravita can sort of cover with experts all the key taxes such as inheritance tax, construction industry, R&D, capital allowances, VAT, and obviously investigations with Dion, who's going to join me towards the end. I think really, before I start, can I put a seed of thought in your mind? If you have a tax problem, you should think, gosh, this is heavy here. I know, I'll contact Gravita. And that's what you should do on all these areas, and we'd be delighted to help you. As an outsider looking in, well, I don't think I'm an outsider anymore. I would say that Gravita, probably more than any other firm of accountants in the UK, assists other accountants in the tax profession. And long may it all continue, really. That's my feelings on everything there. Right, and we're going to start today, Benefits in Kind, Tax Update and Planning. Towards the end, we'll finish at 10 o'clock, but just towards the end, I'm going to be joined by my colleague at Gravita and tax partner, Dion Laycock. Dion's main thing in life, not his whole life, but in his tax life, is that he deals with investigations. He knows that I call him the bodyguard because he protects clients from HMRC. For example, if HMRC are in a meeting and they're saying things and they shouldn't be really saying certain things or asking for things that they're not allowed to ask for, Dion will put a stop to that. Dion is the best guy on investigations that I've ever worked with. So what Dion will be doing today towards the end, probably 10 minutes before the end, he will be talking about Gravita's new product that I think is fantastic. It's a pay-as-you-earn and benefit in kind health check service. And very briefly, but he'll tell you in great detail about this towards the end, but very briefly, what Gravita are now doing is that if you've got a client or one of our clients, or if you're in industry, whatever, and you want somebody to have a look at your benefit in kind reporting procedures, your pay-as-you-earn deductions, your national insurance, the way you apply it. We do a health check service, you know, and we will point, because we've got our real experts doing it, and we will point out, no, you've calculated the benefit in kind wrong here, or you should have applied national insurance where you haven't been. We will give you 100% health check on the way you report and operate pay-as-you-earn, report your benefits and national insurance. But Dion will tell you more about that at the end. It's very popular. It's really a safety net before you have a pay-as-you-earn audit, or indeed, hopefully you won't have one. But it would be nice to feel that you're doing everything correct. And I don't want anybody to take offense by saying this, but quite often the people who fill in P11Ds are not qualified accountants. They're not tax experts. And you know, it's not their fault, but occasionally they will get things wrong, and it could be big implications, detrimental. This health check service hopefully stops all of that and indicates any potential errors. Dion will tell you about that towards the end of this webinar. If you've got any queries on anything I'm saying today, Dion and his team will be delighted to help you. If you need consultancy advice, we can give you that. We probably give that to accountants more than any other firm in the UK. There's the contact email address for today. You want to make a note of that now. And if you have any consultancy work or you want to speak to Dion about the health check and everything, there's the email address to refer to subsequent to the webinar. Leave you to consider that. Right, now I'm getting down to the nitty gritty, okay? And if you go to page 2, the P11D form. Now, you really need a set of the notes in front of you. Jay is brilliant with all the technical side of things. And if you haven't got a set of the notes, quickly have a word with Jay. You can get them and download them. But you want to mark up the notes with my extra comments. And we finish at 10 o'clock today. So you've got an hour, and it's going to be a very detailed 3/4 an hour from me. Then Dion will take over. But I'm going to go through things that I think and I see. And when I do lectures in industry, people get wrong quite frequently. So as well as the planning, I'm going to tell you traps and highlight traps that you want to mark up the notes with, and, you know, report back to your people, you know, if you're doing it yourself, to your clients, and try and avoid any potential errors in this area. Right, the P11D form. You really just want to write in on page 2 of the notes that every entry on the P11D form is VAT inclusive, which I think, honestly, I'm going to give my views today. I think that's unfair, because you put a benefit on the P11D form. Every single entry is VAT inclusive. We dealt with a firm of accountants last year who didn't appreciate that. And they had been filling in P11Ds for their clients, and they hadn't put the VAT on the benefits because they thought you didn't have to do that. It's a common mistake. You know, I'm going to probably give you a dozen common mistakes this morning. That's one of the big ones. But that error is massive, you know, because every entry on the P11D form is VAT inclusive. And so you end up with the company who can recover the VAT paying Class 1A national insurance on the benefits in kind on the VAT inclusive figure. And, you know, you've got to be very careful of this, but that's the rules. When you put a benefit through a PSA, a pay-as-you-earn settlement agreement, which I wouldn't do, but many people do, come on to that towards the end. All the figures, you have to gross up, pay the person's tax through the PSA, VAT inclusive figures. That gets dealt with wrong a lot. Now, you've got a copy in your notes of the 23/24 P11D form. You want to obviously remember that the last P11D form that you're going to be dealing with, completing, is 25/26. From 6 of, you want to just write this in perhaps on page 2, from 6 of April 26 onwards, 26/27, there's no more P11D forms. You want to take a copy of the P11D form, and as I've said before, show your grandchildren when they become accountants. This is what we did in my day. Tax is changing so much. Do you know, Bhavna said to me last night, it's shortly going to be our 30th wedding anniversary. We were going out way before that, but we got married approximately 30 years ago. And when we started courting, I was a big VAT lecturer for a group called BPP. You know, they did student lecturing, they did big public seminars, and as well as that, I was working for a firm of accountants at the same time. We didn't have online tutorials then. You know what, 30 years ago, it just didn't exist. How tax has changed and will continue to change, but you've got to keep up to date with all the changes and the way it all works. Right, so just remember that from 6 of April 26 onwards, the P11D is scrapped completely, and every employer will have to put their benefits through the payroll. I'll come towards that at the very end. Right, remember all of that. Right, let's go to page 4. Tax efficient benefits in kind. Mark Rubinson, who I've been working with for more years than I care to remember, great guy. We were working yesterday on a big piece of work together. Mark, one of Gravita's partners, Mark and I wrote an article a few years ago now about the benefits. All my articles, everything I do is ahead of the game. And Mark will probably tell you when we wrote this article, he can remember it more than me, when we were working for ABG. We wrote this article saying that company electric cars are very, very tax efficient, and they are. I mean, if you get an electric company car, you're only taxed on 2% of the list price. You want to know next year it goes up to 3%, but that is so cheap. In my road, I live in a very nice road just off of Beaconsfield, and we have a big social neighborhood organization where we have summer do's, barbecues. I've had to speak at a few. And loads of my neighbors have got electric company cars. They're top executives. And at the barbecues, they always come up to me and ask me tax-free questions. Well, not tax-free questions, fee-free questions. And they've got these electric cars, but they are clever. They know that they can charge them at work, they can charge them at home, all tax-free. And they seem to be getting the best out of them, even though that some of them driving into London each day, they seem to be doing their charging sensibly, and they beat the poor infrastructure, which, let's be honest, electric company cars, the infrastructure is poor. They seem to beat it. And the last chat that I had with a neighbor who's a top executive for a company quoted on the stock market, he said to me, my company car deal is incredible. Now just look at the screen. And he said to me, I get lots of benefits out of it. And I said, well, tell me what you think you get out of it. And he said, look at the screen. And he said, I'm only taxed on 2% of the list price. And he's got, can I say it, a Jaguar I-Pace, you know, a really, really luxurious fully electric company car. He's only taxed on 2%. 2%, that's nothing compared to 37 when you've got a gas guzzler. And all the repairs and servicing, he drives in it, he uses it heavily for private use. And he's got a very bad track record. The way he drives up and down our roads, I'm not surprised. But his insurance is through the roof, but the company pays it, and it's all tax-free as part of the benefit in kind, 2% times the list price. He's also got a deal where once a week, he gets the car valeted in locally near us, Denham, and they pay for that. He hasn't had to have the financial outlay of the car. He can charge it up at work each day, which he does. All of this is tax-free, effectively within the 2% times the list price. He charges it up at home. When he goes to the local restaurants in Amersham, there's some lovely restaurants there. There's a charging place, and he uses his company charge card to charge up while he's in the restaurant. He hasn't got the financial loss of the car, but the insurance is the big one for him because the premium's massive on a very expensive car, and he's only taxed on 2% of the list price. It's just incredible. That is an incredible deal. I just wish, I know I shouldn't say this, but I just wish the infrastructure, particularly in London, was a bit better. But if you know how to get round it, electric company cars are fantastic. And please don't forget, right? Okay. Please don't forget that if you drive, this is a little extra you want to write in, if you drive a fully electric company van, the taxable benefit is nil. I'll give you an example. My daughter Amy, the apple of my eye, we're very, very close. She has like a flat in our house, really, the top floor. And she has her own TV in her room, but it's been causing her a lot of trouble. And so I said, well, don't worry, Amy, I'll get somebody to come in and repair it, sort it out, and I will be there. And they won't muck me around, and we'll get it sorted. So this guy comes in, and he parks his van in our driveway. And I thought, that's a fully electric van. And I said to him, is that your company van? He said, yeah. I said, is it fully electric? And he said, yes. And I said, do they allow you to use it privately? He said, of course. He said, I use it all day, but then in the evenings, it's down to me. I can use it on the weekends privately. End of story. And he said to me, you won't appreciate this, but there's no tax on me because the rules are that when I drive a fully electric van, it's tax-free. And I said to him, believe you me, I do appreciate that. I thought, I'm not going to go any further. And he didn't know who I was, which I was a bit disappointed about. But incredible. So this guy, he obviously realizes it, and he's got this fully electric van that he was telling me he uses at the weekends to go to the football, all sorts of things. There's no taxable benefit in kind. But you do have to be careful. If you go to page 6, now I said to you that I would illustrate today all the traps. And there's one big trap. Is it really a van or is it a car? This is on page 6 of the notes. And to be a van, you just want to highlight the notes. It's got to be a goods vehicle. Right, what's a goods vehicle? A goods vehicle is a vehicle constructed primarily to carry goods. And if I can just put a previous slide back up, this company who went to one of my lectures in the Midlands, their accountant told me that the client had a Nissan E NV200. You might want to highlight the notes with that. And they treat it as a van. When you look at it, it looks as a van, but you know, they use it to carry passengers. What's the definition of a van? A van is a mechanically propelled road vehicle, which is a goods vehicle. What's a goods vehicle? It's all in the notes. You want to style the notes. A vehicle constructed primarily to convey goods. Well, that Nissan, I think, was constructed equally to carry goods or passengers. And the revenue said it's a CARFA tax. And the extra tax is phenomenal. And they went back 6 years, but the revenue were correct. These are some of the things we will spot for you in our pay-as-you-earn and benefits in kind health check. So you have to be incredibly careful with that. Right, go to the bottom of page 6. Just a quick word in passing. So, I mean, you look at the screen, that's a van for tax, because that was constructed primarily to carry goods. But if you Google and go and have a look on the internet for the Nissan E NV200, you can see that it's not like that. If the vehicle was constructed primarily to carry goods, on the screen now, that is a van for tax purposes, right? Definitely, without a shadow of a doubt. But other vehicles are not, and that's a common mistake that people make, right? Can I just say one quick thing in passing, bottom of page 6? I frequently get asked to help clients install the Cycle to Work scheme. And I think it's absolutely brilliant. Very, very tax efficient. It's a salary sacrifice scheme, really, because the employee pays back the use of the cycle. This is in very general terms in their salary every month for a year or 2 years. Normally it's a year. And the employee pays far less tax, much less national insurance under the Cycle to Work scheme, and the employer has a huge national insurance saving. And at the end of the day, they make a small payment and the bike is legally transferred to their ownership. I think the Cycle to Work scheme is very, very generous. And quite often when I do live lectures, next week I'm lecturing in Shrewsbury, I'm lecturing in Wycombe, round the corner from me at Wycombe Wanderers football ground, which I'm so looking forward to doing. Big audiences as well. I'm going to ask the audiences next week in Shrewsbury and Wycombe, and the following week Taunton and London. I'm going to say to them, how many of you accountants have got clients or your own firms using the Cycle to Work scheme? Huge numbers of hands go up. Why? Because it's so tax and national insurance efficient. Right, leave you to consider that. Go on to page 7. And one accountant in a lecture a little while ago now, he said to me, actually he was in industry, and he said his company provides a fully electric Porsche Taycan for 3 directors, 120,000. What a car. And they're only taxed on 2% of the list price. And you remember those 10 things I showed you earlier, the deal that he gets is phenomenal. And he said it's an incredible deal, the insurance, everything. But he said we all work very, very hard. The company's doing incredibly well. And the company took the decision to get 100% cap allowances on the fully electric Porsche and to provide it for the directors. There you go. Right, can we move on to page 8 of your notes? Go on to page 8, and we're now going to look at other benefits in kind. Now, a while ago, right, one of my friends asked me to help him because he was moving jobs. And he said, Tim, I've agreed my salary, but I'm having one more meeting to finalize before I sign my contract. He's switching jobs, bold move, but they headhunted him, they wanted him. And he said, can you come with me to the meeting and go through my benefits in kind? And can you tell me what's tax efficient, what's not, the benefits? Can you help me push for the ones? And we did a lot of preparation before the meeting as well. And I was a bit like an agent, which I've always deep down had a secret passion to be, a football agent, that is. And so I go along with him. And I said to his prospective employer, are you going to provide my client with medical insurance? And the company said, yes, he will join our AXA scheme. And I said, well, tell me how it's going to work. And they said, right, we're going to invite him, his wife, and his kids to join the AXA scheme. And they have AXA doctor at hand. And I said, explain that. And they said, well, if he's ever ill or his wife's ill or kids are ill, they can go on the app and they will get an appointment within 24 hours. And if they need a consultation, all of this is within the medical policy. They'll get one free. And if he needs an operation, they're free. I mean, operations, they can cost over £3,000 now. And so I said, does he need to tell you about his health history? Because we were a bit canny about this, but my client had some health problems that I'm not going to go into, serious health problems. Hopefully he's over them. And they turned around and they said, I don't know if I've got it on the slides. No, probably not, but just you can hear this. They said, no, we don't need to know his health history at all. He just joins the scheme. The company was so big that they never asked about health history of the prospective employees. They just allowed them to join the scheme. I thought, wow. So with his poor health history, hopefully he's over that now, but it's still on his record. And his wife and his kids, they've got AXA at hand. They can get this free medical insurance, appointments free, the doctor at hand, free operations, everything. And I said, well, what's the taxable benefit in kind for all of this? And they said 1,800 a year. And the tax on that obviously is going to be, he's a 45% taxpayer, 810. And I said, well, privately, when we had a little break, I quietly said to him down the corridor, that's a great deal. You've got to go for that. And he said, yeah. And he has. And he's used it now because obviously it's there and he's used that policy. So I think in a lot of cases, medical insurance is a tremendous benefit in kind. Depends on all the facts, the scheme and everything. But the benefit in kind in the ones I've dealt with for the top executives has tended to be quite low. Right. One other thing that I'm really surprised about is that his company said to him at the meeting I was at, if you've got any expenses, you have to use the company credit card. Otherwise, you're not going to get them reimbursed. And so I said to the director of the company he was joining, I said, how does it work? And they said, we'll give him a company credit card. It's in his name, but he's got to use it. He can't claim any expenses unless they're on the company credit card. I said, fair enough. And I said, out of interest, when he uses it, does it rack up air miles that he can have? And the company said, yes, it does. And it does, and it has done. And he's about to have a trip at Easter using his air miles on his company credit card from his employer. When we were down the corridor, he says to me, am I taxed on the benefit of having these air miles? And I said, no, you're not. It's a loophole. Other countries have corrected the loophole. The UK hasn't. So it really is a good tax-free perk, if you like, for a director to have a company or a top executive to have a company credit card that he's using. with the air miles given to him. And as I say, he's got a lovely holiday in Easter shortly, a few weeks' time, paid for by the air miles, tax-free, which I think is incredible. Right, okay. So all of that is a marvelous opportunity. Sooner or later, they'll tighten up on that. I was asked to include that in an article last year. I said, no, I'm not attracting publicity to that. And while it's tax-free, let it stay tax-free. Incredible. Right, now one thing that I love is a company using and giving trivial benefits in kind to their staff. All right. Now, trivial benefits in kind are benefits less than £50, but that includes VAT. All these benefits includes VAT. So it's the cost of the benefit to the employer plus VAT. If that is under £50, not greater than £50, the benefit is exempt if you meet the conditions. I think it's incredible. Right. So what are the conditions then? Well, let's just go down. The cost of the benefit, including VAT, to the employer must not exceed £50. It cannot be a benefit that you can convert into cash. For example, I love Waterstones, and one company that I know gives £50 Waterstones vouchers to their staff occasionally, and they do it at Easter. So they'll be getting it and they're saying Happy Easter and they're giving it to them. That's tax-free. So long as the Waterstones vouchers cannot be converted into cash. For example, you buy a few books, cost you 48. You give the £50 voucher. If they give you cash back, it blows the whole thing. There must be no cashback facility. So what you've got to do is just to check to make sure that if you're giving retail vouchers to the staff, this company does not have a cashback facility on the voucher. The trivial benefits must not be in your contract of employment. And the last thing, you can't say, Johnny, you've done a brilliant piece of work. You are a superstar. Thank you. I know you love red wine. Here's a beautiful bottle of red wine. It cost us £45. You can have it. Thank you very much. You're having this because you've done a brilliant piece of work. You came in on a Saturday. If you do that, it's taxable. The benefit must not, the trivial benefit must not be provided in recognition of services performed by the employee. Okay, that's the key, one of the key conditions. You've got such detailed notes today. You really want to go away and look at my notes after this webinar. And more people are giving benefits at various times, trivial benefits under £50, tax-free to their staff, and the staff love it. For example, last November, my wife Bhavna, obviously Gujarati, I speak Gujarati. Muni bahu but lagije. That means I'm very hungry. That's Cockney Gujarati. Some of you may not understand it, but I had a late night last night watching Emma Raducanu because I'm a big fan. And so I haven't really had breakfast this morning. So muni bahu but lagije. I'm very hungry. But at Diwali, the Indian New Year, which is November time, a lot of accountants, a lot of clients, a lot of employers give boxes of fireworks or vouchers for fireworks to their staff saying, celebrate Diwali. Kemcha, celebrate Diwali. And they do that. People give trivial benefits in kind for the most strange benefits, but they can do it. Congratulations on the birth of your child. Congratulations on getting engaged. Congratulations on your marriage. Happy anniversary. You can do all of it. You can be creative. When I was lecturing in-house recently to a company in industry, they said that they gave 6 trivial benefits each year to their staff, tax-free. The revenue had looked at it and the revenue approved it. What are the type of benefits that you can give? We'll go over to page 9. Loads of things. Christmas hampers. You might struggle to give a Christmas hamper costing less than £50. Perhaps it will be a second-hand hamper. Now, I'm only joking. But yeah, you can do so many things. As I said, fireworks, all sorts of things you can do. And the employer loves it. And the employees loves it. Leyton Orient, they're my second team. The way Tottenham are playing at the moment, they're my first team. Orient are playing tonight, which I'm going to watch on Sky Sports. They're playing Stevenage. Hope they get in the playoffs. But one employer did give Orient tickets, so they were well under £50. And this one's interesting because one employer recently said to me, we arranged for our employee who loves tennis, we bought him a tennis lesson. And they said it was under £50. But then they said to me, the tennis coach charged VAT. And I said, well, he shouldn't have charged VAT. And they said, why not? I said, because there's an exemption. If the subject that you're teaching is ordinarily taught at school or university, you don't have to charge VAT on the private tuition if you're an individual. And that was wrong, actually. They had been charging VAT. So forget benefits. I got involved and I told him to stop charging the VAT. He actually deregistered. We won on that many years ago before I got involved with Gravita. And for when I was working previously, we put a claim in to say that tennis is ordinarily taught at school. I went to Forest School, and at my school was David Felgate, who became Tim Henman's coach. He was a pupil at school while I was there, and quite a bit younger than me, Mark Petchey, who has been in the news this week because he's been coaching Emma Raducanu. I'm very involved in the tennis scene. I played at Connaught Tennis Club. I don't know if any of you know, it's a very famous club in Chingford in London. The Petchey family founded it. And Mark, I know through playing at Connaught, I played for their teams. Mark was there, but he was a lot younger than me. So I used all that experience, and we claimed that tennis is taught at school. The revenue accepted it, and we've been successful with golf as well, because golf is taught at university. But that's another separate subject for a VAT webinar or lecture. But you know, Gravita can help you with these things. So just for 1 minute, if I go a bit wider, if you've got VAT issues on all these things, for example, there was a guy who gave sailing tuition. And we did a bit of research, and sailing is taught. There's courses on that at university all over the place. We put a claim in, revenue accepted it. He deregistered, and that meant that his lesson charges were, you know, far cheaper to the public because he didn't have to charge VAT. They couldn't recover it. But that's a side issue. Anyway, can we move on? Right. Okay. So I love trivial benefits in kind. Right now, but you've got to remember, though, if you look on page 9, that there is an upper limit, a cumulative limit on the benefits you can provide each year for directors of £300. You want to start that. You know, 1 hour is not really the time to go through everything in great detail. What I'm doing this morning is highlighting things, and you've got to work a bit hard away from this webinar when I'm finished to go on the internet for certain things that might be relevant to you and your clients. What you also want to do is take these notes away when you go away for Easter, because quite often you might be on a beach if you've gone away for the Easter holidays like I intend to do, and you need some reading. These notes would make excellent holiday reading. Right, go to page 10 of your notes. Go to page 10. Now, we dealt with an employee a couple of years ago now, and he was a lovely guy, but he couldn't drive. He was the world's worst driver. If I knew that he was taking a driving lesson near the employer's place when I was due to go there, I parked the car early and I walked. I just didn't want to get involved. And he failed his driving test many times, but they loved him. So they bought him a company motorbike, and he had the use of the motorbike. And they said to me, what's he going to be taxed on? I said 20% of the value of the motorbike, box L of the P11D. And I said, that's the law. He's going to be taxed on 20% of the value of the motorbike when you first provided it to him. And do you know, they did something stupid. What they did, they gave him the motorbike, and because he'd wrecked it in a dreadful state, it dropped in value like a stone, and he paid the market value, which was peanuts. And they put on box A of the P11D, hold on, the market value. Well, that's wrong. This is the next trap. If the employees had the use of an asset, then you sell it or give it to him the employee is taxed on the higher of two things. Go to page 10, the market value, or when you give it to him, or if higher, and this is always higher, the original value when first loaned to him, less what he's been taxed on. This is a big trap that a lot of employers get wrong. So, for example, Callum has a company motorbike bought for 10,000. Will he be taxed on 20% of it? He wrecks it and it's worth 2.5. He pays 2.5. Most accountants or clients filling in the P11D will put market value 2.5, paid 2.5, benefit nil. That's not right. The correct benefit, this is all on page 10. If I'm going too fast, star the notes, you can look at it after the webinar. The correct benefit is the cost of the value of the motorbike when first provided, less what you've been taxed on, 20%, 8,000. Less what he paid, and he paid 2.5. So the taxable benefit is 5,500. Most accountants will put nil. So can I just go through that again? It's the greater of market value less what the employee paid, or if greater, it's always greater, original value when first loaned, less what he's taxed on, less what he paid, £5,500. All in the notes there on page 10. That is always dealt with wrongly. So you need to be careful. These are the sort of things that we will flag up when we do our pay-as-you-earn and national insurance health check. Now, some wonderful planning. Box K, go over to page 11 of the P11D. Love it. If you, as an employer, provide a service or a benefit to an employee, and there's no extra marginal cost in providing the benefit, the taxable benefit is nil. Can I say that again? If an employer provides a benefit to an employee and there is no extra marginal cost in providing the benefit, the taxable benefit is nil. Right. If you've got a pen there, you could jot any of this down. This all started decades ago in really the 80s, but early 90s. The 80s were a wonderful generation. Kachagoogoo were there, Rick Astley, Swing Out Sister, Climby Fisher. Anyway, so really, I started getting involved in this in the 80s, and I suddenly realized, wow, an employer could provide a benefit, and if there's no extra cost in providing the benefit, but it's still a good benefit for an employee, the taxable benefit is nil. And there was a case on this, which really started in the 80s, and then ultimately in 1992 went to the top courts. The taxpayer won. The taxpayer was Mr. Hart, and he was a schoolmaster at Malvern College. I went to Forest School, very sporty school, as I told you. We had Mark Petchey, David Felgate. We had top footballers at our school who went on to play for professional clubs, and we were playing Malvern College. Malvern College was the college where Mr. Hart taught. And Mr. Hart was a teacher at Malvern College. And in August, he said to the school, "Can you allow my son to come and stay in my class?" It was a boarding school. And they said, "What, is he going to be a boarder?" And Hart said, "Yes, please." So what the school did, they worked out the costs of him boarding, having an extra boy in the class, his stationery, his food, and Hart reimbursed all of that. And the revenue had a pay-as-you-earn audit of Malvern College, and they said, "Mr. Hart, your son is educated at the school." And he said, "Yeah." And Malvern College turned around and said, "Yeah, that's the case." And the revenue said, "Well, he should be taxed on the full public school fees, the benefit of being at the school." And Hart said, "No, it's only the extra marginal cost of the employer providing the benefit, and the extra marginal cost is the extra cost of the boy being in the class, his books, his meals at lunchtime, his laundry, because he was a boarder." And Hart said, "I reimburse all of those. There's no taxable benefit." And to cut a long story short, he won at the tribunal, and then, he won at the very high courts. And ever since that case, I've been doing planning. I always remember, right, when I'm doing a big lecture in London many years ago, this lady waited till everybody had gone at 5 o'clock. And she said, "Mr. Palmer, I'm the financial accountant of an airline. And she said, we gave a free flight to Dubai, you know, at the last minute to an employee who could do it because he had family in Dubai, literally got on the plane. He was working for this airline and his office was round the corner from Heathrow. And at short notice, he accepted the flight and the revenue taxed it. And we said, it's not taxable. I said, it's not taxable. There's no extra, it wasn't in his contract, was it? And they said, no, we don't normally do this, but it was just a one-off. I said, well, it's not taxable. There's no extra charge to the airline in having the guy have a place on the plane. And they said, well, can we engage you to win it for us? I said, yeah. So I started correspondence, and HMRC then said to me in the correspondence, was the plane full? And I said, yes, but that's irrelevant. They came back and said, well, there's been a financial loss to the airline in having an employee take the place. I said, that's irrelevant. It's only the cost to the employer providing the benefit. Any financial loss is irrelevant. In the end, I was disappointed we won, but the revenue didn't send a letter agreeing they were wrong. All they did was they just sent out of the blue a closure notice, which was wrong, a little disappointing because I wanted them to say in writing that they agreed that we were correct. There was no taxable benefit. If you go to the P11D guidance notes, right, they unbelievably, HMRC give you some huge guidance, and I'm going to call it tax planning on the use of Box K. And I repeat, if there's no extra marginal cost to an employer in providing the benefit's nil. We won a battle a few years ago with the revenue where there was a top tailor making suits. He was an incredible tailor. He made suits for people who were on Sky. And his employees, two of them, said, will you make us suits? We'll buy the materials and pay everything for you. And he said, well, I'm really busy. I'll do it in my spare time. And he did. And the revenue tried to tax it on the employees. And I wrote back and said, well, there was no extra marginal cost to the employer in providing that benefit. You want to have a look at the guidance notes on Box K of that P11D, huge planning opportunity. I've done that massively. I haven't got the time today to give you all the examples I've done, but huge examples. Right, okay. Now moving on, just go to car parking for a minute. You've got to be a bit careful with that because it's only tax-free if the employer provides car parking at or near the place of work. We had a case that we were given and we couldn't do anything about. They got it wrong. And this company provided a Jaguar car, which is very taxable, expensive benefit. And they said to the direct employer, he wasn't a director, he was almost director, but they said to him, well, drive to your local train station, which was Beaconsfield, funnily enough. And they said, park the car there, get the Chiltern line, half an hour. If you do it properly, it's 26 minutes, incredible. To London, we'll pay for your car parking. It's tax-free. Later, he comes to me and I said, well, it's not tax-free. And he said, well, the company's accountants, who are huge, said it is. I said, they're wrong. To be tax-free, it's got to be at or near the place of work. Your car parking is at or near your home. Then you get the train to work. It's not tax-free. And I actually had to speak to the accountants, which were a very big firm. I'm not going to say their numbers, but and they eventually admitted, sorry, we got that wrong. So that's another trap. You've got to be, our team could help you with that, but you've got to be very careful about. Now, a few years ago, in a lecture, a lady in industry said, we got a company helicopter. This is page 12 of your notes. And she said, the company helicopter, one of the directors uses it privately. Have I got this? Yeah, company helicopter. And I said, what, just a few times in the year? They said, yes, the director uses the company helicopter for private trips a few times a year. And they said, we put it on Box L. He's got the use of the helicopter, 20%, apportioned by the days over 365, I think it was 70 odd, that uses it privately. And I said, correct. And I said, well, what about the other benefit? And they said, well, what other benefit? And I said, the running costs for those 70 odd days. And they said, it's all covered by Boxtel, 20%. I said, it's not, it's an extra benefit. So look at the example. I've loosely based the example on what they did. David, an employee, got the use of the company helicopter for 73 days in the year privately. Okay. The helicopter, when first used, was valued at 300,000. He'd be taxed on 20% of that times 73 over 365, plus the running costs, which are 20,000. So there's two benefits. So you always want to remember that if you've got the private use of an asset, motorbike, small, helicopter, big, yacht, whatever, you're taxed on two benefits: the 20% apportion calculation, and also the running costs for the private usage in the year. That benefit was 32,000. They put on the P11D 12. So they were 20,000 out. So these are the sort of things that we can do and have a look for and check for you once we've been given the green light to assist you. One other thing I would say, I'm going to switch to Dion in a minute. He's champing at the bit to get on, but I'm just going to carry on for a few more minutes, Dion. Is that okay? 3 more minutes? Jolly good. Right. Late night taxis are tax-free and they are fantastic. For example, we help somebody who is a manager at a hotel, but he does the day, and they're to switch him temporarily to the evenings. And he lives quite away from work. And he said to me, they're going to provide me with a late night taxi. And I said, well, it's tax-free, not a taxable benefit if you meet the conditions. Go to page 12. The conditions are that you've got to be working until at least 9 p.m. After 9 p.m. It was irregular, it was. And he only did it a few times a year. But in the end, I think he did it 25 times. And the cost of the taxi was about £80, all tax-free. Late night taxis for staff who work after 9 o'clock in the evening. We help a firm of solicitors, and they use this a lot. I also helped somebody working on TV, where he was working at lunchtimes, doing the TV programs at lunchtimes. They temporarily switched him to the evenings, and they gave him a taxi to take him home. We negotiated with the revenue that it was tax-free. Now, for 2 more minutes, the remainder of the notes highlight key things that are very relevant to benefits in kind. It will take me 2 minutes, and these are reading material, and I strongly recommend that you go through them and have a look at them after the webinar, just for 2 more minutes. So very briefly, go to page 13, chapter 2. Can I remind you, this is a real shame, employers' NIC goes up to 15% on the 6th of April, 15. Currently it's 13.8%. I've known to grow and love the fraction 13.8, but you'll never use that again. Now it's 15. There's only one good thing here. Employees, when they get benefits, do not have to pay personal national insurance on their benefits in kind. Long may that continue, but there is a strong rumour that Rachel Reeves is going to extend Class 1A to employees from 6th of April next year. I wonder, we'll have to wait and see. Go to page 14. As I mentioned at the start, the P11D form is scrapped from 6th of April 26. Do you know what you should do? You should try out payrolling a year in advance. I was speaking to an accountant this week, and he said, I've switched my clients to payrolling voluntarily so I get used to it for a year. That is a massive change. No doubt, possibly Gravity will do something separate on that in due course. We've got a team that could help you with payrolling of benefits, but that is a big thing. And finally, from me, last point, I wrote an article on payrolling benefits almost 10 years ago now. I said it was the future. People take 10 years to catch up with me. I may have mentioned this to you before. I jokingly said to an audience once, if you go on eBay, you can get a signed copy of that article. And that was a joke, but one man took it very seriously. And then a few days later, he emailed me and said, I've been trying to get a signed copy on eBay and I haven't been able to. And I had to apologize to him. So can I stress that you can't go on eBay and get a signed copy of that at the moment? And finally, I wouldn't do them. All right. I think pay-as-you-earn settlement agreements are very, very expensive because you have to gross up, you have to pay Class 1B, and you've got to remember that Class 1B national insurance, 15% from 6th of April. And finally, can I just say, double cab pickups, page 16. If you are thinking of buying a new double cab pickup, you want to order one before the 6th of April. Because if you do, and you allow an employee or director to use it privately, it's still taxed as a van until the 5th of April, 2029. It's all in the notes. So there's some good transitional rules there. If you leave it late and you buy the double cab pickup and let the director use it, employee use it, and you buy it after 6th of April, it's treated as a car. When you buy it and it's treated as a van, the tax is £2,000 odd. There you go. When you buy it after 6th of April, it'll be treated as a car, and the tax isn't 2,000, it's 13,000. Right, I'm finishing now. I'm going to hand over to Dion, but can I just say this? I've given you a lot of thoughts on benefits in kind, some planning opportunities to do. You want to go through the notes again after this webinar, but you do want to watch out for the traps. And Dion is briefly going to talk to you about the health check that Gravita now offers to companies, to clients, and I think it's very worthwhile. So over to you, Dion.
Thanks, Tim. Thanks for that. Interesting run through for benefits, always useful. Just a bit about me. I lead our tax investigations, tax risk mitigation and disclosure service at Gravita. And a lot of our work is reacting to HMRC inquiries and investigations and representing clients when they're unfortunate enough to be visited by HMRC. The part of our role that we don't see as much of is the tax risk mitigation. So in essence, you put yourself in a position where if you are unfortunate enough to have an HMRC inquiry or investigation, you can demonstrate to them relatively quickly that you've taken your filing obligations seriously and you've instructed someone to review those. And very often that helps with HMRC to say very quickly, we're satisfied that everything's operating normally, and you can save yourself a bit of money. So it's almost a way to think about it might be that it's like an insurance policy. You know, I'll pay a smaller amount, hopefully up front, to have that review rather than the larger amount with an inquiry or potential costs of inquiry. That could be having a review, an internal appeal, essentially, mediation, alternative dispute resolution, tribunal. Those costs are significant. And the tax risk mitigation is a way of trying to say, well, actually, to HMRC, look, we are compliant and we can satisfy you with that pretty quickly. So the backdrop to that is that the tax gap in 22-23, as you can see on the screen, was 39.8 billion. They reckon about 34% of that is attributable to income tax and national insurance, bits of capital gains tax. But income tax and national insurance is mainly or largely through pay-as-you-earn. And HMRC reckon about 46% of that is where people haven't taken reasonable care, or they've had an alternative, and in HMRC's view, incorrect legal interpretation of the tax law. Now, any of you that have had an investigation will know that officers of HMRC take quite an imaginative approach to the law and sometimes ignore it altogether. So they can come to some wild conclusions when they take that route. So part of the tax risk mitigation strategy, if you like, is to head that off at the pass. If you look at HMRC's compliance handbook and the operational process behind a pay-as-you-earn inquiry, they say, well, we're going to check into the employer's obligations to deduct and account for pay-as-you-earn and national insurance. So on the next slide, you can see what that might involve. So their mindset is, well, the employer has an obligation to operate pay-as-you-earn and NICs and deduct and account for those accordingly. And very often, particularly in the pay-as-you-earn and national insurance legislation, there are fine lines between interpreting what the law says. And those grey margins are ripe pickings for HMRC. So they will look at, how do you operate your pay-as-you-earn and national insurance procedures? How do you operate your payroll? How do you report benefits in kind? All through that list. So worker status, particularly, that's an important one. How do you deal with off-payroll workers, and are you dealing with them correctly? Termination payments are another area where HMRC love to get involved with, and post-employment notice pay. The things that Tim was talking about earlier as well, travel expenses, business mileage, entertaining, are those being dealt with properly? Cars, fuel. Quite a big one as well is employees entering and leaving the UK. Now, that's particularly important for national insurance, because where we have a social security agreement with other jurisdictions around the world, it might be that you have to treat different employees differently depending on where they go. So that is quite a big one. Split or dual contracts is another one. Do those contracts do what you think they do? In your mind, you might say, well, that's perfectly clear to me, but does it fit HMRC's interpretation of what they say the law is? Salary sacrifice is another one. Had a case very recently where they came to us quite late in an inquiry where HMRC were seeking to disapply their salary sacrifice arrangements for pensions. Now, in your mind, you might think, well, that's a no-brainer. Pensions are salary sacrifice, but you have to go through the process properly. And HMRC almost undid this client, but we managed to fend them off. But so even obvious things like, well, pensions must be eligible for salary sacrifice. Generally they are, but you still have to go through the process properly. And part of that risk analysis, that risk mitigation review that a pay-as-you-earn health check does is to test that, is to look at it. And that's ahead of time. So we're looking at it ahead of time before HMRC look at it. Because if HMRC look at it and they find something wrong, they won't just stop there. They'll go back to other years as well. So part of the health check is to sort of say, well, look, are we compliant now in the current year? And if we're not, we can correct it in the current year. And if we're not compliant in the current year, and we can correct it in that year, but what about earlier years? We can go back and think about a disclosure. So there are ways of correcting it. If you go to anything with HMRCs, if you go to them first and it's an unprompted disclosure, the penalties will be far lower. And that's what this is all about, is the penalties. The tax is the tax, the interest is the commercial restitution, but the penalties can be significant for failures to operate pay-as-you-earn. So that's what we're looking at. So if you move on to the next slide, please, Steve. What does a review involve? Well, essentially, it's like a tax investigation, but without HMRC officers. It's friendly people testing the systems. It's how are you operating your payroll, your expense, your benefit, your incentive procedures? Are there national minimum wage considerations you should be considering? Construction industry scheme, off-payroll workers, they're important ones, IR35, anything like that. Exemptions and relief claims. That's a really important one because, like the salary sacrifice and the pension, it might seem obvious that it's tax-free. We're providing living accommodation for the proper performance of their employee's job. But is it? What makes you say that? If HMRC asked, how would you demonstrate that it is provided for the proper performance of the employee's job, or it's customary, or it's for their security? How have you got to that conclusion, and how have you documented it? Employer-supported childcare. Have you gone over the prescribed limits? Are you within the statutory tax-free limits? Health screening and medical checkups. Are you sure that doesn't cover medical treatment, because treatment isn't tax-free, whereas the screening and the checkup might be? Medical treatment abroad, you can pay for that tax-free if it's necessary. So, if it turns out that someone had cosmetic surgery abroad, you'd probably find it difficult to argue that was necessary. Not in every case, but probably in most cases. So there are things like that. The incidental overnight expenses, have they been dealt with properly? Long service awards is another one. Is it for service over 20 years, and is it within the limit? And have you made a payment in the last 10 years? Things like that. Trivial benefits that Tim was talking about. Are they in performance for work? How have you documented it? What have you put there? Because if they are, they're taxable. Low and interest-free loans, have you calculated the interest properly? Has that been reported properly? Employee share. So there are all those sorts of things, and this is all about identifying risk areas and highlighting them to you before HMRC do, and correcting them. So you might consider a health check every sort of few years to say, is there something wrong in the current year? Can we correct it in the current year? Was there something wrong in earlier years? And we would look at the assessment timeliness of that, about how far back we would go and how far back HMRC could go. So very quickly, and in a nutshell, that's what the pay-as-you-earn health check is all about. It's really putting you in a position to say to HMRC, we've got all of this covered if they come looking. So I think I've whizzed through that in about the sort of 10 minutes or so. But we're always happy to help. Here's my contact details. Always happy to have a chat as well. So look, pop me an email if anything like that. You want to discuss anything in relation to that, and we'll help wherever we can. And with that, back to you, Tim.
Thanks very much, Dion. That was great. Yeah, this health check is really worthwhile. There's so many different people watching this webinar. I think there's almost 400. I think there's people in industry. We could do the health check directly for you if you wanted. And for accountants in practice, if you've got a few clients that, supply loads of benefits and you're a bit concerned, we could do the health check for them as well on a case-by-case basis. As Dion said, we'd be delighted to help you in this area. Right, just a couple more minutes and then I'm going to finish and you can get on with your day. I have to say that I think Gravita is excellent in providing benefits, tax benefits in particular, to the profession. And if you go to Gravita's website, you will see a list of them. There are quite a few. Can I just highlight some of them? On the 30th of April, I think Michaela Lamb and her team, who I think are truly excellent, there's an IHT planning update. Everybody needs IHT advice now and planning following the autumn budget last year. You really want to have a look at that. And on the 1st of May, you've got Making Tax Digital, something that I'm very involved with, both in practice and lecturing. And I think that is a very important webinar that Gravita are putting on. I think most accountants will need to attend that. I mean, there was a change made in the spring statement yesterday that eventually I think it's from memory, 6th of April 28, the turnover figure goes down to 20,000, and then you have to comply with these quarterly accounting requirements on Making Tax Digital. Making Tax Digital, which comes in for sole traders and landlords who've got turnover greater than 50,000 from 6th of April next year. So we're 1 year away. You've got to start preparing for that. So have a look at that webinar, and Gravita can assist you. We've got experts on Making Tax Digital who can really help you in that area. And then the last one, but there's others, have a look at the Gravita's website on the 26th of June, quite a specialized webinar, but a really useful one, maximizing your intellectual property. If you go to Gravita's website, you can see all the details behind those courses. I'm going to finish now. Can I thank you guys for taking your time out today to watch this webinar? Hopefully some of the things that I said on benefits were useful to you. There's planning opportunities, but there's also traps. Keep liaising with your clients, and we'd be delighted to assist you with a health check in the future. Thank you very much. Enjoy the rest of your day. Bye-bye.